It's a very good question. I think this is a very complex debate. I mean, it was very easy to say in early July when yields reached record lows that bond prices were heavily overbought. So you needed a sell-off then. But we're 3 months down the line now. We're 3 months into this sell-off and bonds are oversold. So I think it's tough. For choice, I fall on the side of the equity guys. I think there's a bit of reflation going on. We've digested a lot of the initial economic slowdown impact of the oil price fall. And in Australia, much of the iron ore price fall has been digested. So you can get a bit of reflation in economies, added to which central banks, coupled with governments, are moving towards more fiscal stimulus. And of course, a bit of inflation pressures coming back. So I'm kind of in the camp positioning became very extreme bond bullish in July. And we're only starting to shift that positioning the other way now, 3 months into this bear rally or bear movement in bonds. So I kind of think it's got more legs, and the sector rotation in equity markets will play out with that, as we've seen in the last 3 months with equity guys moving towards cyclicals, financials, IT and so on, and out of the defensive yield plays. So probably more to go. Well, we've been tactically underweight equities until the beginning of October, having enjoyed a lot of the rally from Feb through to March. We missed the final bit, but we've been tactically underweight post-Brexit as well. We've switched that to overweight from beginning of October. So we've seen our market timing models generate a super strong sell post-Brexit rally in late July, early August. That encouraged us to put that underweight on. Those models have unwound. This is what's interesting. They've unwound, yet markets have gone sideways. That says to me there's a lot of underlying buying interest. Markets signals unwinding with markets treading water is very impressive, and I think prepares the ground for the next move higher in equity markets. So start moving overweight. I think is the key here, and this rally could last into Christmas and certainly considerably long into Q1, maybe Q2. Yeah, I think we're in the end of the cycle. We're just arguing the toss over how many quarters are left. And we're at the end of the cyclical bull market. We think there's one final flurry. This is a time when you sort of move along the risk curve away from the riskiest stuff. I think a good example of that is US high yield corporate bonds or European high yield corporate bonds. They should be very low or zero weighted in portfolios. That's the thing that tends to underperform first. So I'd move towards big caps. I'd move towards the US with a preference of the US over Europe and Japan, and start concentrating the risk in the more safer risk, if you like. Yeah, I mean, that's all part of the reflation, I think, and the Fed backing away and so on, and China putting more stimulus into its economy and the China housing boom in tier one cities that we've seen. I mean, I think one just has to think about how far that's gone to rekindle one's concerns about some of these commodity prices. Yes, they may go a little bit higher, but iron ore going over 60 when really the clearing price is 30 to 35. That's driven by what we see in China. I think that's driven by this switch of an equity market bubble in China, which peaked in June last year, into a tier one housing bubble in China, whereby Shenzhen house prices on average are more expensive than Sydney. I think that says it all. I would be cautious. Yes, it may run a bit further, but this isn't the beginning of a great big bull market for commodities. No way. This is a proper bear market rally in a downtrend, I think. Well, I'm actually thrilled post-Brexit because things have been certainly proven initially to be much better than people expected. The macro data has held up better than people thought. We haven't had the huge confidence shock leading to negative economic outcomes that people expected. Yes, there are still risks, there are still investment problems. I'm deeply encouraged by the democratic process in Britain, by the level-headedness of our government at the moment. We have obviously a new Prime Minister and a new cabinet, and I think they're laying the groundwork very well for an exit from the European Union, and I think they'll come up with a very good plan. And the more I see of it, the more impressed I am. So sterling's taken a tumble. Sterling to me is a very attractive currency at these levels. I think in one final flurry for equity markets, we probably have another move higher in the dollar. So if I think about where should capital be going in the world, I think the US ticks a lot of the boxes. You look at Europe and you're concerned about the euro position, you're concerned about the banking system, the migration, and so on. You look at Japan, it works when the currency goes down, not when it goes up. Yes, some people like a bit of emerging markets. I'm not so convinced myself. I think the dollar's got more than the rest. And the currencies I like in the world are the dollar and the pound at the moment. I think they're the two that tick most boxes.